Investing for the first time can be intimidating and confusing. There are so many articles, YouTube videos, and worst of all, bad financial advice from friends or colleagues. Yuck. If you're looking for beginner portfolio ideas, I'm going to recommend a very easy to follow portfolio, and I'll recommend a few alternatives depending on your age and risk tolerance. Before I get into it, if you're a beginner Canadian investor and you're looking for tips, advice, or starting points, I've created a free small ebook to give you some guidance. All you have to do is sign up with your email to get access. Investing has a lot to do with age and risk tolerance. The closer you get to retirement, the less risk you should take, in my opinion. You could take as much risk as you want, but you get the point. Also, even if you're not close to retirement, the stress or psychological effects of a risky or volatile portfolio might be too much for you to handle, so you can vary your choices there as well. For me, I like risk. I want the highest risk possible, the highest returns possible. So I plan to retire at 55, so that might be 25 more years, I guess. As a beginner investor, I recommend you to invest in two things, 50-50, in either your RSP or TFSA, or both, or neither. Neither. You'll invest 50% in an index ETF and 50% in dividend growth stocks. This is as basic as I can make it. An index ETF is a collection of tens, hundreds, or thousands of stocks that you can buy all in one basket, all under one umbrella. Dividend growth stocks will provide safe and increasing quarterly cash payments. Starting with the ETFs, depending on your risk tolerance, you can invest in the following Vanguard ETFs. These are the most popular. You'll see or hear them recommended all the time in many videos or articles. For my young or risky folks, you'll invest in VEQT. It is 100% stocks. Buying this one ETF will have you invested in 13,000 different stocks all over the world. Just buy it, hold it, keep investing in it monthly or quarterly until you retire. If you're getting closer to retirement or don't want as much risk in the market, instead of VEQT, you can invest in VBAL, VBAL. This has 60% stocks and 40% bonds. Bonds are fixed income. They pay you interest. Your initial investment in bonds shouldn't fluctuate. Lastly, if you're like 5 years away from retirement or super risk averse, I would recommend VCIP. This is 70% bonds, 30% stocks. So stocks are risky. So 30% is risky and 70% is safe. 70% of your investment is fixed interest paying investments that won't fluctuate. I wouldn't recommend going 100% bonds until you're actually retired, but then you probably wouldn't be watching a beginner portfolio video anyway. I might even show a video of how to buy one or two of these stocks on Questrader Wealthsimple if I haven't done that already. Moving on to dividend growth stocks. If you watch any of my previous videos, I like dividend growth stocks. I like the idea of receiving monthly or quarterly cash payments. I can start seeing tangible rewards from my investments as quick as 30 days. I would take these dividends and reinvest them into other stocks. I wouldn't withdraw the cash until I was retired. I would choose one or all of the following if you'd like: a Canadian bank, a Canadian energy company, and a Canadian telecom company. My current recommendations are CIBC, Telus, and Enbridge. CIBC is ticker symbol CM.TO. It's $63 per share. If you have $1,000, you can put the entire $1,000 into this stock and start earning dividends right away. Owning this would pay every 3 months. Every year, you'll make 5.24% or $52.40. The reason I chose this is because, Canadian banks are safe. CIBC has a high dividend, and ideally, they'll increase their payments every year. I don't just want $524 every year if I have $10,000 invested. I want it to increase with inflation. If not, I want it to beat inflation. Enbridge is ENB.TO. It currently is trading at $54 a share. Again, if you have $1,000 or $5,000, it's totally fine to invest the entire amount into Enbridge. At one point, I had $44,000 invested into this one company. Currently, they're paying dividends every 3 months, and you'll make 6.21% or $62.10 per year if you've invested $1,000, or $621 if you have $10,000 invested. Again, I chose this because it's safe and has increasing dividends. Lastly, Telus, ticker symbol T.TO. Make sure you're not buying T in USD because that's AT&T in the US. So if you only have Canadian dollars, make sure it's T.TO and it's in Canadian dollars. They're currently trading at $28 per share and they pay 4.71% per year. This is my new favorite telecom stock after Rogers had that massive power outage and clearly didn't have any backup plan or proper infrastructure in place. So I'm going with Telus. If you have $10,000 invested in Telus, you'll make $471 per year. That's it. That's all I'm recommending. Pick an index ETF that I've recommended, pick one or all of the dividend paying stocks that I recommended, and you'll be fine. If you only have $1,000 right now, you can do $1,000 into an ETF. 3 months later, you can do $1,000 into CIBC. You don't have to do 50-50 every time. Just to make it easier, buy one thing at a time with all your money. In my opinion, anything under $25,000 is a beginner portfolio. If anyone is watching this and they're wondering, oh, what about currency risk? What about international exposure and rebalancing? Those questions and comments are too advanced for what I'm trying to do here. That might be an intermediate question or a question for an intermediate portfolio video. These two recommendations are for beginners who want something passive, something relatively safe, and something with a clear history of making money. If you're watching this in 2022 or early 2023, we'll be in a recession, or we already are in a recession. It's a scary time. Almost no stock or industry is safe. All prices will go down, everything will get reset, but I promise if you invest for the long term, we'll rebound, we'll be fine. We've had 12 recessions and we've rebounded 13 times, I think. I just made that up. Leave me any comments or questions, and don't listen to financial advice from family, friends, or colleagues. That's all, folks.